It's week 4, the halfway point of our Fall 2 session class. Hello, everybody. This is Professor Hasse speaking again live and in color from Claremont, California. It's week 4, cost of capital and capital budgeting, our halfway point of our class. You have submitted your case number 1. I'll be reviewing that this week and posting the grades by Friday and talk a little bit about that in my Friday update video. We also have a case number 2 posted now. Today is Tuesday, November 15th. The case number 2 is posted. It's a spreadsheet format, capital budget, and risk analysis of a company. And it's due in 2 weeks. You have 2 weeks to do this work, due Sunday, November 27th, a capital budget analysis. We are spending the next 2 weeks on chapters 9, 10, 11, and 12 over the next 2 weeks to talk about, 9, 10, and 11 over the next 2 weeks to study capital budgeting. Can't say anything more important in financial management is to be able to have the ability to do a strategic analysis of an investment in an asset and determine its profitability and cash flow before it even takes place. That's what this is all about, determining the cost of capital and the return on the investment. So that's what we're going to be doing, a lot of spreadsheet analysis now over the next couple of weeks. So brush up your analytical and calculating skills. Here we go. So again, let's take a look at our Blackboard to see where we are and where everything is this beginning of week number 4. Okay, our Blackboard is all set for this week number 4. If you want to go to the case study file folder, you'll see your work for this week, both in a PDF and a Word doc format. It's the same information, giving you the details of putting together a capital budget. You also see a rubric of how I'll be grading the case, and also posted later on this week with my Friday update will be a template spreadsheet that you will use to do your work on. I will provide the spreadsheet. You will fill it in, fill it out, and that template will be used in your work for this week. So to help some of us who don't have much experience with financial templates and spreadsheet templates for financial analysis, I will provide the spreadsheet. You will fill in the blanks and do the designated math or calculations in that spreadsheet. We'll talk about that in my Friday video. What I would like you to do this week, in addition to reviewing chapters 9 and 10, is also to read this case, get to understand what is being asked of you in the format of the lecture spreadsheet that I'm giving you tonight. And that lecture spreadsheet is in week number 4. There it is right there, week 4 lecture class review. That spreadsheet is what I'll be talking about tonight. And on Friday, it's a sample of a capital budgeting risk analysis, and that will be subsequent to your template, which we'll talk about come our second video of this week. So these are the tasks that we have at hand this week. Also, since this is the halfway mark of our class, it'd be advisable for you to take an assessment of where you stand in the class. Take a look at your grade center, as I post the case number 1 later in the week, where's your grade? Do you understand your grade? Do you have a problem with your grade? Do you need some help? Do you need some review by me? Again, remember, we have our office hours every Thursday evening, 6 to 8 p.m. If you need to ask me any questions about your grade, the work, whatever. And also, I'll be available throughout the weekend and also into next week. Next week is Thanksgiving week. We still have work to do. You have your case number 2 due the Sunday after Thanksgiving. Sorry about that, but welcome to 8-week courses. And so I will be available throughout the period for any help or extra study you might need in doing this work. As I mentioned, what I would like you to do this early part of this week is to download and take a look at the case. Remember, case number 1 was doing a paper explaining the risk assessment of a company that you selected. Case number 2 is doing a risk assessment, capital budget assessment in a spreadsheet of data that I provide you. You don't have to look up the data. I provide the data, you convert the data into an analysis. So what you're doing in this problem is doing a capital budget analysis for this base case. You're going to be doing a net present value, internal rate of return, profitability index, and payback in years analysis of this investment. Also, you'll be determining the cost of capital of this company using the weighted average cost of capital and the capital asset pricing model that we've already talked about and worked on in case number 1. There's the specifics of the cost of capital. Here are the specifics of this capital budget case. It's a $700,000 7-year investment with the following depreciation, salvage value, working capital, base, inflation rate, tax rate, units sold per year, selling price per unit, fixed cost per year, and manufacturing costs or variable costs per unit. You are to do a base case analysis of that. Then you do a scenario analysis and a sensitivity risk analysis. These will be all talked about this week and next in the subsequent classes and videos of this class. Now, many of you who have recently completed business finance or finance related courses, this might be somewhat familiar to you. Others, and it's been a while since you've had finance or this is your first time through, you got your hands full this week. So take a look at the templates, take a look at the videos that I show explaining the work, read chapters 9 and 10, look at the videos posted, and you should be in good shape. This is what we're doing this next couple of weeks. We're doing a capital budget analysis. Now, what a capital budget is, a company wants to invest in a new asset to grow the business, to provide cash flow, to provide profits, or a new market. So they're going to invest assets. In other words, invest capital. Where do they get the money to fund those assets? What is it going to cost them in debt, in equity to get those assets? What is the depreciable life of those assets? That sets the length of time of the capital budget analysis, the depreciable life. What are the planned income, revenues, operating expenses? What's the net cash flow per year of that investment? That includes working capital, salvage value. And then once you compile the net cash flow per year, what is the net present value? What is the percentage return? What is the profitability index relative to cost? And how many years does it take you to pay back the initial year 0 investment? And then once that's completed, what is the risk of the numbers? Are the numbers you're working with correct? Do they make sense? That's the scenario and sensitivity analysis. It seems like a lot, but once we get it all done and organized, no problem. Easy for me to say, huh? So this is the file that it will be our initial look at the capital budget analysis talked about in chapters 9, 10, and 11 over the next couple weeks. Remember, the first step is to determine the cost of capital. What does it cost us to get the money to invest in an asset? We've looked at these components already. Now we're going to put them together into a calculated analysis. Here's the example we're using here. Our debt to assets percentage is 60%. In other words, 60% of the capital structure is in debt, interest-bearing debt. Interest-bearing debt at 9%. The company's tax rate is 30%. So if their debt position is 60%, that means their equity position has got to be 40% in their capital structure. It's got to total 100%. Their cost of that equity or 40% is determined by the capital asset pricing model. The risk-free interest rate relative to the market premium rate and the company's specific beta. So let's put together this cost of capital. If our interest rate on our debt is 9%, we're going to take that 9% and multiply it times 1 minus the tax rate of 30%. In other words, we're trying to determine the after-tax cost of debt. What is, we have to pay 9% on the debt. That's no questions asked. But also we get to deduct a certain portion of that debt based on our tax rate. So we get to deduct 30% of the 9% on as a tax deduction. So our true cost of debt is less the tax of 30% or 9% times 70%. And that is, oops, excuse me, put the numbers in wrong. Let's do that again. 9% times 1 minus 30%. And we get, okay, Mr. Hasse, let's go back to the drawing board here. Equals 0.09 times 1 minus 0.3. Get rid of that. And there we go. All right, just put in the wrong zeros. 6.3%. Sorry about that. I looked like an idiot. So 9% times 1 minus 30% is 6.3%. That's our after-tax cost of debt. That's what it's costing this company to pay for their debt after taxes. So we weight that by the capital structure of the debt, 60%, and we get a weighted average cost of debt of 3.78%. That's taking 60% of our 6.3. Okay. Now, what is our cost of equity? Well, you've done this before in your case number 1. The cost of equity is the capital asset pricing model, which is the risk-free rate, 0.0375, plus the market premium, which is in this case, it's given, you don't have to calculate it. Remember, the market premium is defined as the market rate of return minus the risk-free rate. Well, here I give you the market premium, so we're going to add that to 0.09, the market premium, times the beta of the company, 1.25. And we get 15%. So 3.75 plus 9% times 1.25 equals 15%. Pretty high cost of equity. So we put that cost of equity of 15% and we weight it by the 40% capital structure percentage of equity in the balance sheet. We get a weighted average cost of equity of 6%. Thus, we have our cost of capital. At this point of time, due to our cost of debt, our capital structure percentages, our tax rate, the risk in the market at no risk, risk-free rate, and average risk, market premium, and the specific risk of the company in the market, the beta, we have a cost of money of 9.78%. That's what it's costing us to get our capital today. So that 9.78% is going to be our discount rate once we put together our capital budget analysis. And so let's put this right here, 9.78. That is our percentage of WACC for our analysis. So now what we're going to do, we're going to make an investment of $1 million. We're going to have a salvage value. We're going to have depreciation. We're going to have units sold. We're going to have sales price. We're going to have inflation. We're going to have variable cost per unit. We're going to have inflation. We're going to have fixed cost per unit. We're going to have inflation. We're going to have a tax rate, and we're going to have a working capital rate. Our job this week is to fill this in. I'd like you to try to do that during the course of the week. And then on Friday, I will walk through this and see if your work is the same as mine. We'll determine the net present value, internal rate of return, profitability index, and payback, all talked about in chapters 9 and 10. We'll do the risk analysis. talked about in chapter 11. That's going to be jumping ahead of next week, but we'll be doing that as well. You're doing all of this analysis, this exact same sheet, except the numbers are different and the years are different for your case number 2. To be able to strategize and interpret an investment, you have to understand the decision making into that investment. And that's what this capital budget analysis is. So if you want to try to give this a whirl during the course of the week, go right ahead. If not, I will walk us through in our Friday update video. The Friday update video is going to be quite involved. We're going to go over this. We're going to go over the template for the case number 2. And we're going to go over the results of case number 1 so you understand how I graded that work and what was the outcome of that assessment. So a lot going on in the Friday update video. This week, we're setting it up. Your job is to maybe look at this spreadsheet, look at the material and see if you can put this together. If you notice in the spreadsheet, I have a lot of the formulas or math or the arithmetic already done, which makes it a little easier. So go ahead and try to do this. If not, just go ahead and study this work in chapters 9 and 10, review it, get back up to speed on a capital budget analysis, and we'll go from there. But before we go, let's take a quick video to explain this process again. So let's take a look at that video.
The goal of capital budgeting analysis is to determine whether a project is profitable based on today's dollar value. This approach is appropriate because the project costs are in today's dollar value and the expected cash flows from the projects are in future dollar value. To make a decision on whether to accept or reject a project today, both cost and future cash flows must be in today's dollar value. The factors involved in capital budgeting decisions are future sales, expected cash flows, capital expenditure, timing. The purpose of any investment is to generate profit. To generate profit, first the firm needs to generate sales, manage costs, produce positive cash flows that are large enough to recover the investment, and generate profit. In addition, business does not have access to unlimited capital, and the availability of capital will influence the investment decision. The timing of each cash flow affects the present value of cash flow, and the timing of investment will affect the future revenues. Capital budgeting projects are generally classified as replacement, expansion, safety, security and environment, and other. Companies have to replace old equipment because of breakdowns, lower productivity, or technological obsolescence to maintain the production capability of the firm. Replacement projects are the most common capital budgeting project in the business. Expansion project occurs as a result of companies' strategy to produce new product or to enter new market or new industries. A change in environment and government regulation leads to safety, security, and environmental projects. Other projects are research and development projects based on the strategic planning of the firm. The goal of the capital budgeting analysis is to determine the profitability of the project. Profitability of the project is determined by analyzing 3 cash flows of the project. 1. Cash outflows, the money invested in the project. 2. Cash inflows, money generated from the investment. 3. Terminal year cash flows, money received from the sale of the used assets at the end of the project. Let's draw a timeline for capital budgeting project. Assuming the life of the project is 5 years. Cash outflows are posted on the left hand side at period 0. The cash flows are negative because money is going out of the company. Cash flows generated from the project are referred to as cash inflows and occurs after the investment. They are positive because money is coming into the firm. Assuming that the equipment can be salvaged, the salvage value and any other end-of-the-year cash flows from the project are posted on the year 5. The goal of the capital budgeting analysis is to determine profitability of the project. The investment in the project is made on period 0 and the cash flows will be received at a future date. In capital budgeting analysis, all the future cash flows, which is CF1, CF2, CF3, CF4, CF5, and terminal year cash flows for year 5 are brought to today's value by computing the present value of the cash flow. The difference between the present value of the cash flows and the initial investment is referred to as net present value. If the present value of future cash flows from the project is greater than initial investment, the net present value is positive and project is profitable. The following are commonly used decision criteria to evaluate capital budgeting project. Number 1, payback period. Number 2, net present value. Number 3, internal rate of return. Number 4, modified internal rate of return. Number 5, profitability index. Payback period. Payback period is the amount of the time required to recover initial investment in a project. It ignores the time value of money. Net present value. Net present value is the difference between present value of cash inflows and present value of cash outflows. Internal rate of return. Internal rate of return is the rate of return at which the net present value of the project is equal to 0. In the IRR calculation, it is assumed that cash flows from the project are reinvested at the internal rate of return. Modified internal rate of return. Modified internal rate of return is based on the assumption that cash flows from the projects are reinvested at the cost of capital, which is weighted average cost of capital. Initial investment is equated to the sum of the future cash flows that were reinvested at the cost of capital to compute the interest rate. Profitability index. Profitability index is the ratio between present value of cash inflows and present value of cash outflows. Project acceptance or rejection criteria. If net present value is greater than or equal to 0, project is acceptable. If the net present value is less than 0, reject the project. Internal rate of return is greater than or equal to cost of capital, project is acceptable. If the IRR is less than cost of capital, reject the project. Modified internal rate of return greater than or equal to cost of capital, accept the project. If MIRR is greater than or equal to cost of capital, project is acceptable. If MIRR is less than cost of capital, reject the project. If profitability index is greater than the 1, accept the project. Profitability index is less than 1, reject the project.
Okay, not the most thrilling of videos, I can honestly say, but it just gives us the overall view of what you see in front of you is a capital budget analysis. It's a determination of net cash flows, determining revenues and expenses, the initial year investment, your cost of capital, that's your discount rate, and the net year or life of the project by its depreciable life. So what we'll be doing is filling this in, determining our net cash flows, determining our investment return analysis by 4 different methods. Do not worry about the modified internal rate of return mentioned in that video. We will not be responsible for that. But what is our return in dollars, percent, in a ratio, and in years? That's what we'll be determining. Then coming out of that, we'll look at sensitivity analysis heading into the second week of our analysis. So that's what we're headed to this week. Try to review, try to set this up, and take a look at case number 2 and get a feel for what you have to do for that. And we'll talk more about that at the end of the week. Thanks, everybody. Have a great week. We'll talk to you later. Adios.